Now that we have an understanding of who and what moves the market, now we could delve into price action. The fundamental aspect of price action trading is understanding who is moving the market, not necessarily why the market's moving, because that's unknown to us. Price action, the fundamental aspect of trading, is always following one of three patterns. It's either going up, the price is either going down, or the price is typically staying flat. When the market's going up, it's an uptrend. When the market's going down, it's a downtrend. And when the market is relatively flat, this is considered consolidation. We're going to go into each of these types of market conditions and go into some more detail. Nasdaq E-mini futures, factors influencing upwards price action movement. What causes upward price action movement in the Nasdaq E-mini futures contract market? An upward shift in price action can be caused when there are more aggressive buyers than passive sellers. In the futures market, the price action is determined by the collective decisions of all market participants, including individual investors, financial institutions, hedge funds, etc. These decision-making processes involves a dynamic interplay of supply and demand for futures contracts. With each change in price action is telling a story of this ongoing struggle. This is particularly significant in swing trading, where traders seek to capitalize on the price movements over a period of time. Upwards price movement in the price action occurs when the demand for contracts from buyers outweighs the supply of contracts from sellers. It's also important to remember that these are aggressive buyers versus passive sellers. More specifically, aggressive buyers are market participants who are willing to pay a premium or a higher price to acquire the Nasdaq E-mini futures contracts immediately, rather than waiting. They place market orders that are executed at the best available price without limit, and their aggression can be observed in the price action. This contrasts with passive sellers who place limit orders specifying a minimum price they are willing to accept to sell their contracts, and are content to wait until the market reaches their specified price. When the price action reflects more aggressive buyers than passive sellers in the Nasdaq E-mini futures market, the higher demand for contracts drives up the price. An aggressive buyer exhausts the available supply at current prices. They must accept higher prices to fill their market orders, which further accelerates the upward momentum of the price action. This effect can be seen more prominently if there's low liquidity, i.e., a shortage of sellers willing to sell at current prices, as each executed order can significantly impact the price action. This is a vital point to consider when swing trading, as identifying these dynamics can help identify potential opportunities for profits or places where risk mitigation strategies can be implemented to reduce risk. E-mini Nasdaq futures, the forces driving downwards price movements. In the Nasdaq E-mini futures contracts market, similar to any other futures market, prices are shaped by a complex interplay of supply and demand, reflected in the price action. When the price action of a futures contract shows a decrease, it is often due to an imbalance where supply exceeds demand. This is a crucial aspect to consider when swing trading, as these movements form the basis for the entry and exit points for our trades. Downward price movements in the price action occurs when the volume of contracts supplied by aggressive sellers outnumbers those demanded by passive buyers. Aggressive sellers are market participants who are eager to sell their Nasdaq E-mini futures contracts immediately, even at a potentially lower price. They place market orders which are executed at the best available price regardless of how low that may be. This impatience or urgency is often visible in the price action. On the other hand, passive buyers set limit orders, specifying the maximum price they are willing to pay to buy a contract. Their patient approach is reflected in the price action, as they are waiting for the market to come to them, as opposed to aggressive sellers who are actively pushing the market and the price action downwards. When the price action shows more aggressive sellers than passive buyers in the Nasdaq E-mini futures market, the increased supply of contracts combined with the reduced demand causes the price to fall. As these sellers continue to flood the market with contracts, they must accept progressively lower prices to fill their market orders, which drives the market price downwards even further. This trend can be visible in the price action and can be magnified in situations of low liquidity, where there is a shortage of buyers at the current prices. However, it is important to remember that these supply-demand dynamics reflected in the price action are not the only factors affecting price movements. Broader market sentiment, geopolitical events, macroeconomic indicators, and other variables can also significantly influence the price trends in the futures market, particularly in high-volume markets like the Nasdaq E-mini. While the imbalance between aggressive sellers and passive buyers is a fundamental driver of downward price action, it is crucial for traders to consider a broad array of information when analyzing the price action. Speculating on potential market behavior and forming their swing trading strategies. After all, swing trading is all about capturing price movements over a period of time, and this requires a thorough understanding of all the market dynamics. E-mini Nasdaq futures. Is flat price movement or consolidation a sign of indecision? When swing trading the Nasdaq E-mini futures contracts, it is essential to understand periods of consolidation. During these periods, as revealed in the price action, the number of aggressive buyers is roughly equal to the number of aggressive sellers. In other words, there's a balance of power, with neither side gaining the upper hand. The buyers and the sellers are evenly matched in their trading aggressiveness, leading to relatively equal amounts of contracts being bought and sold, which results in a narrowing of the trading range or sideways price action, which most people call consolidation or indecision. This balance, visible in the price action of the Nasdaq E-mini futures contracts, can be disrupted when a new piece of information enters the market, an economic event occurs, or simply the market sentiment has shifted. When one side gains the upper hand and the price action, either buyers become more aggressive or sellers become more aggressive, the price will start to move out of the consolidation range. While consolidation reflected in the price action does indeed represent a state of indecision or tug of war between buyers and sellers, it is also a situation when neither the buyers nor the sellers are able to dominate the market direction. It is a period of relative equilibrium or a standoff in the market, observable in the price action until a breakout in either the upwards or downwards direction occurs. In the context of the Nasdaq E-mini futures contract, market consolidation often indicates a point where the larger market participants converge to transact at an agreed upon price. This phase, discernible in the price action, reflects a time when the commitment levels of both aggressive buyers and aggressive sellers harmonizes. This means that there's mutual recognition of value, causing neither party to have pronounced advantage or disadvantage. During this phase, there is a balance with equivalent levels of contracts being exchanged, leading to the market moving in a sideways trajectory or within a confined range. Such a consolidated state, though signaling a kind of stability in the price action of the Nasdaq E-mini futures contracts, can be vulnerable to shifts. For example, consider a situation where a key financial report is due to be released. Market participants might have already positioned their trades based on their anticipations. Once the report is out, and if it contains unexpected data, it can immediately tilt the scales. Those on the wrong side of the prediction might scramble to adjust their positions, and in such moments, the previously observed balance can be disrupted. A surge in buying or an intensification in selling can push the price out of its previous consolidation range. Therefore, market consolidation is not just a reflection of indecision, but more crucially, it denotes a segment where larger market participants find mutual agreement in the asset's value. This alignment in the price action sets the stage until new variables like the aforementioned financial report causes a breakout or breakdown, reshaping the market narrative. Price action during consolidation periods in the Nasdaq E-mini futures contract market can be complex, but they provide useful insights into the balance of power between buyers and sellers, therefore offering potential opportunities for strategic trades when the breakout finally happens. Understanding these periods of consolidation and how they interpret the price action is a critical role for day traders to understand to become successful at swing trading, trading the range, trend following, or many other trading strategies. Nasdaq E-mini futures, a case study of price action movers in the market.